The major index is rising more than 1.5% Tuesday afternoon ahead of the earnings from tech titans Amazon and Alphabet. Well, it's been a volatile year so far, not to mention 2020. Let's find out what all this volatility means for stocks with someone who studied these volatile periods, Nick Colas of DataTrek Research. Good afternoon, Nick.
Good to see you.
Good seeing you too, Nick. So it's been a wild 2020, and January has been choppy. It's extending into February now with this Reddit-fueled trade, whether it's going up or going down on those squeezes. Based on the past periods that you've studied, how bad is this current period, 20 to 21, and how long do these periods last?
It's fascinating because every cycle is a little bit different. Volatility is almost always the same. So if you look back at prior periods, and either whether you look at the VIX or just the number of 1% days the market sees, the pattern's always the same. It peaks in, say, whatever quarter the peak of the crisis is. We'll call it Q2 of 2020, 38 1% days, for example, or the VIX peaking at 83. It always takes 2 to 2.5 years to get back to what we would call normal, a VIX of 19, or only having 1% day a week instead of, think of just the last 5 days. I think we've had 3 or 4 out of the last 5 days. So it's a long, grinding process to get volatility back down to levels we would all think of as more normal.
That means if we're talking about, for example, March 2020, we're talking about 2022 when it possibly subsides, or as you say, 2.5 years extending beyond that. What happens during that 2.5 year period to the stock market?
In general, it rises because one of the fascinating things about things like the VIX is that it's negatively correlated to stock prices. So when the VIX goes up, stock prices tend to go down. And when the VIX declines, stock prices tend to rise. And so what happens is markets are just readjusting their expectations of future earnings, future multiples. That takes time. The volatility is a symptom of that debate the market is having about where earnings are really going to settle out. And then finally, when they do, the volatility declines because earnings power is much better understood than it was a year or two before, right after the crisis occurred.
Well, Nick, looking at the most recent volatile period that fueled by those Reddit-fueled stocks, the short squeezes that drove up prices of, for example, GameStop or AMC, or even the silver squeeze that we just saw yesterday, now all those prices are coming down and coming down sharply. Do you think it's game over for this amateur day trader, social media fueled phenomenon?
I don't think it is over because I think these traders are learning, and we've seen their learning curve for the past 12 months. They started by just buying stocks in the middle of the downturn. And by the way, we're roundly criticized for, they don't know what they're doing, buying the airlines and casinos and the hotels. Made some good money doing that. Then they picked up options in the middle of last year, and now they're beginning to understand short squeezes. So you can really see a community of investors learning in real time what tools to use, how to manage risk. And so with that tool set growing, they'll still be here for a while.
No longer dumb money then.
No, not dumb money. Look, they were the smartest money on the street back in March, buying when everybody else was selling. They did really well.
All right, Nick. And finally, going from Wall Street to Washington, some Senate Republicans presented President Biden with a much smaller fiscal stimulus proposal amounting to around $600 billion versus his $1.9 trillion package. So which size package do you think will Wall Street prefer? Will they prefer that he walk across the aisle and come with a compromised smaller figure, or is it better if he sticks to the bigger one in terms of investors' eyes?
Certainly in a perfect world, Wall Street would want to see the bigger package because it's simply more stimulus for the economy, and it gives you a much higher level of certainty on corporate earnings for Q2 and Q3. However, Wall Street's super pragmatic, and they understand that's not going to happen if Republicans are saying they want a different type or size of package. So I think the Street's absolutely expecting a compromise, and we'll get one.
Okay. All right. Is there any magic number that the Street's looking for that's good or bad for stocks?
I think just round numbers, $1 trillion is a good baseline number to think about. Anything more than that's probably mildly positive. Less than that's mildly negative.
Okay, we'll keep watching that $1 trillion figure. Thanks a lot, Nick.
Thank you.
Our thanks to Nick Colas of DataTrek Research in New York City. I'm Fred Katayama in New York. This is Reuters.